Okay, we're in Module 6. Welcome back. And first I'm going to talk about in Learning Objective 1, inventory costing method. And inventory is the cost of producing or buying goods that you sell. So when a company makes inventory and then they buy it from a supplier, it's going to be capitalized as an asset, merchandise inventory on the balance sheet. And inventory is always a current asset. And then when the company sells the asset, it comes out of inventory on the balance sheet and it goes into the income statement as cost of goods sold, an expense. And the thing to be aware of here is that there are a lot of different ways of measuring inventory. And the other issue that comes up with inventory is obsolescence, inventory that has lost its value. So first off, to talk about inventory costing method, the issue here is which inventory was sold. In other words, you may have purchased 10 of the same unit, but some cost more than others. Which ones did you sell? And that's what inventory costing method, LIFO, FIFO, is really all about. I hope this is a review. So if higher costs are transferred from the balance sheet, then cost of goods sold are going to be higher. If you move to the income statement rather, from the balance sheet to the income statement, the more expensive goods, probably the ones you bought later, then you're going to have lower cost of goods. You're going to have higher cost of goods sold rather, and lower gross profit. Whereas if you transfer the lower cost units, i.e. the ones that were purchased earlier, that would be under FIFO, we'll talk about it, then that would assume be under LIFO, then lower costs would be transferred over cost of goods sold, and therefore the company would be reporting higher gross profit and higher net income. So the inventory costing method that the company uses can actually have a significant impact on income. We'll talk about LIFO and FIFO in just a moment. Capitalization is a very important concept in the course, and in case you don't remember it, capitalization is the basic idea that you can book costs as assets rather than as expenses. So for example, if you buy inventory and you don't sell it yet, then you really have an asset because you can use that inventory and you can sell it at some point in the future. So inventory is a capitalized asset, and what you would usually do is you capitalize it for whatever you paid for it, the purchase price. Now, if you're manufacturing your own inventory, then the cost is going to consist of three basic components. One of them is called raw materials. That would be whatever you initially put into production, whatever materials you put into production. One would be called direct labor. That is the cost of paying the people who worked on the items to make it. And the third one is called manufacturing overhead. And this is the cost of manufacturing the goods. This is the cost of running the factory, besides the materials and labor. It's basically everything else. So, again, what you would have to do is you'd have to go through this, and it's very complicated, figuring out what the cost of the materials, what the cost of the labor, and what the cost of the overhead was. Add it all together, and that's going to give you the total cost of goods manufactured, which is then going to be capitalized. And once you sell it, it'll go into cost of goods sold. Gross profit is a very important figure on the income statement. It's going to be sales minus cost of goods sold. So again, as you sell the goods, you take them out of inventory and they go into cost of goods sold. And then you use cost of goods sold. It's usually the largest expense on a company's income statement. The cost of goods sold is used to calculate gross profit. Now let's go over again how to calculate cost of goods sold. Cost of goods sold, a basic formula, and this is a formula worth remembering. Beginning inventory plus purchases minus ending inventory equals ending cost of goods sold. Again, let me go over that again. Beginning inventory, and this beginning inventory would be the same as ending inventory last period, plus inventory purchased minus ending inventory equals cost of goods sold. And a good way to think about it is the diagram below. That is your beginning inventory plus all the inventory you purchased, inventory acquired, would comprise total goods available for sale. So goods available for sale consist of two components. One, whatever you started the year with, and two, whatever you purchased during the year. And then that's everything that you had during the year. Now, some things are still here, that's ending inventory, and some things were sold, that's cost of goods sold. So again, once you have your cost of goods available for sale, part of those costs, part of those goods are still here, that would be ending inventory, and the rest of them were all sold, that would be cost of goods sold. So that's the logic here behind this formula. Beginning inventory plus inventory purchased equals cost of goods available for sale. That's everything that was available during the year, minus ending inventory would give you cost of goods sold. And again, beginning inventory is whatever ending inventory was last year. And inventory purchase would be a situation when you're buying your own inventory. Let's say you're a retailer. But if you're a manufacturer, instead of putting inventory purchased in there, you would be putting in cost of goods manufactured or produced. So COGM, cost of goods manufactured, would go in there instead into inventory purchased if you were making the goods instead of selling them. Now, there are three basic methods of calculating, of estimating the cost of inventory. And what I mean is these are cost flow assumptions. And they answer the question of which items that you sell. So you may have a shelf full of goods and they all look identical, but you bought them at different times and you paid different prices for them. So the question is, which ones did you sell? Did you sell the earlier ones, which cost less, the ones that you purchased earlier, that is, which cost less, or did you purchase the ones that you purchased last, which cost more? Now, the way you manage inventory, if you ever walked in a warehouse or a store, or a supermarket is a good example. Growing up, I had a job at a supermarket, and the way you stock shelves is you go and you get your whatever, boxes of whatever you're going to stock the shelves with, and you get a table. You got to do the table. And the supermarket I worked in, they had all these tables with wheels on them. So the way you would stock shelves is you would take everything on the shelf off, and then you would take the new stuff and you would put it in the back. Then you would take the old stuff and you'd put it in the front. And this is always how you manage inventory. If you notice the milk case in the supermarket or at 7-Eleven, the old milk is in the front, that's the milk you take. And the new milk is in the back, that's the milk that you don't take. Because what would happen if everybody took the new milk? That the old milk would sit at the back of the shelf and it would spoil. And that's true for every kind of inventory that you're going to have. You're always going to want to get rid of the old stuff before you sell the new stuff. And you actually move the items around on the shelf to make sure that when customers buy merchandise, they're buying the old stuff and not the new stuff. That's called FIFO, first in, first out. And it's actually a slogan that people use, warehouse clerks use, when they manage a warehouse, because they always want to sell the old stuff before the new stuff. You leave the old stuff at the back of the shelf, it spoils, and you got to throw it away. So obviously, when I go to the supermarket and I buy milk, I take everything off the shelf and I reach all the way in the back and I take the newest milk, and then I put the old stuff back in. And they make that very difficult for you to do, but who wants to buy old milk, right? Anyway, let's give an example. Let's say that this company started off the year with 500 units that cost $100 a unit. So the total cost is $50,000. And then during the period, they bought 200 units at $150 a unit. Total cost $30,000. So the total cost of goods available for sale would be 700 units, and they cost $80,000. And let's also assume that they sold 450 units. So the question would be, how much did those units cost? Did they cost $100 a unit, or did they cost $150 a unit, or some combination? If you're using FIFO, you're going to assume that all 450 units were the first units the company had, the ones that were sitting on the shelf already on January 1st, and therefore they cost $100. So at the bottom of the screen here, you can see the sales, which is 112,500. That's 450 units times $250 a unit. Minus cost of goods sold, that's 450 units at $100 each, because that's how much the beginning inventory costs. So total cost of goods sold will be $45,000, and therefore the gross profit is going to be $67,500. Now, what's remaining in stock? There's 50 units left from beginning inventory at $100, plus the 200 that you bought during the year, which are 150. And that's what's left on the shelf, so that would be ending inventory on the balance sheet. LIFO, last in, first out. The way last in, first out works, and it's purely an accounting fiction, and the truth is, between you and me, it's an American accounting fiction, because no other country would allow LIFO. International GAAP strictly prohibits LIFO. It says you cannot use it. If you're using LIFO, then your companies are not in accordance with IFRS. That said, the United States has LIFO. About half the companies use it, because if you use LIFO, then what companies like is, and I'll explain it in a moment, LIFO, if prices are going up, LIFO lowers your income. And you're allowed to use LIFO on your taxes with one little catch. So companies like to use LIFO because LIFO tends to lower your profits, and therefore it will lower their tax bills, at least temporarily. It's called a tax deferral. It's not really a tax savings. Anyway, so that results in lower taxes. The IRS has one little catch, and that catch is that if companies use LIFO in their financial statements, assuming a company uses LIFO on their tax return, then they also have to use LIFO in their financial statements. So therefore, companies like LIFO because it saves them on taxes or it defers their taxes, and therefore they use it on their financial statements. About half of companies use LIFO. So LIFO works the other way around. Last in, first out, or the way one of my professors used to put it, first in, still here, fish. So, same scenario again. We started the year with 500 units that cost $100 a unit. They were already on the shelf. We bought another 200 units at $150 per unit. So what's happening here is that we have the oldest items at the back of the shelf, the newest items at the front of the shelf, so to speak. Not really, because everyone manages their inventory. They always put the oldest stuff in front. But this accounting assumption of LIFO assumes it's the other way around. So this assumption says that if we sold 450 units, we sell price was $250 a unit. Don't confuse sales price with cost, by the way. Then where did those units come from? Well, of those 450 units, 200 were the most recently purchased, and they cost $150 a unit. The remaining 250 of the 450 units came from beginning inventory, and they cost $100 a unit. So you add those together, as it's shown here at the bottom of the screen. That gives you cost of goods sold of $55,000. Sales were again $112,500, and gross profit is $57,500. Now notice here that your gross profit is $10,000 lower. So if this was your taxes, you would have $10,000 less income. If you're at a 34% tax bracket, or let's say under the new Tax Act you're 20%, 21% tax bracket, that would be a $2,000 tax deferral. In other words, you can pay $2,000 less in taxes this year because you're using LIFO. Now, again, all companies are going to use FIFO. That's how you manage your business. But for financial statements, half of companies use LIFO. Another method is called average cost, and this is like something between LIFO and FIFO. And what it does is it kind of figures out what everything costs on average. So here you can see, I'm going to have to show you how they calculated this. Same scenario, but what we need to do is we need to figure out how much goods cost on average. So I'm going to make a little text box here and I'll show you. We would take 80,000, because that's the total cost of goods available for sale, and we would divide by the number of units available for sale, and that would give us the average unit cost, or $114 again, the formula would be the formula for this would be the formula would be cost of goods available for sale divided by number of units available for sale. That would be your formula to calculate the average cost per unit. And we are trying to shade this a certain color. I don't know. Can't seem to see it. Anyway, there's your formula. So cost of goods sold, you would figure out what the average was. In this case, we sold 450 units. They cost $114 each. So total cost of goods for sale is $51,429. Gross profit was $61,071. Now, something else that companies do is they use an assumed cost of goods sold. It's called the retail inventory costing method. And we go over this in intermediate accounting or financial reporting. It's usually not taught in an introductory accounting class. And instead of having companies go and count all of their inventory, they use retail inventory costing instead. Now, companies have to count their inventory at least once a year. Some companies will count it twice or 4 times a year, but they don't always count it on exactly the last day of the year, and inevitably they have to use some estimation. So what they would do is they would use the following method. Retail and inventory costing method relies on an assumption that your cost to retail percentage is consistent. So what you would do is you would figure out your cost to retail percentage. You would figure out the retail value of the inventory that's sitting on the shelf, and then use that to figure out the cost of goods sold. So let me take you through this. We figure out the cost of goods available for sale. In this case, it's $100 beginning inventory plus $300 in purchases equals cost of goods available for sale of $400,000. We also figure those out at the sales price. So the sales price of the beginning inventory is $160. The sales price of our purchases is $500. So the sales price for the goods available for sale was $660,000. That gives us a cost to retail percentage of 60.6%, 400 divided by 660. So this percentage is really important because it's going to help us figure something out in a moment. The next thing we do is we figure out our ending inventory. So we had $660,000 sales price available. We go and we see we had $420,000 in sales. So therefore I must have sitting on the shelf right now $240,000 worth of inventory at retail price. Now we never value inventory at retail on the balance sheet, but it's good to know how much inventory is there. It's $240,000 at retail. Now what you might do is you might actually count it to see if it adds up to $240,000 or something close. If not, then you have something called shrinkage, i.e. the inventory is getting stolen or damaged. Okay, if we know that the inventory has a sales price of $240,000 and we know the cost to retail percentage is 60.6%, then I know that the inventory on the shelf at cost would be $145,440. So 240 times the 60.6% is going to give you $145,440. Now I apply the formula for cost of goods sold. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. So in this case, cost of goods available for sale is $400,000 at cost. We figured out the cost of ending inventory is $145,440, and therefore cost of goods sold would be $254,560. And this method is used to estimate cost of goods sold. So here you can see a comparison of the 3 methods that we have. Retail inventory, by the way, could be used with LIFO, FIFO, and weighted average. It can be used with any one of these. It's just a way of estimating the inventory when it's too difficult to figure out what the cost is. it tends to be today, and I'm recording this in 2018. I doubt anyone's ever going to see this after 2018. But here in 2018, everybody has computers, and this is all done by computer, and you don't have to go through a shortcut anymore. The computer will do it the right way for you. It's programmed properly. But anyway, here you can see there are big differences between LIFO, FIFO, and average cost, and therefore, as financial analysts, we would be interested in this because we may be looking at a company and its competitors, and one company uses FIFO, and then the other company uses LIFO. So the competitors' financial statements might not really be so comparable because they're using different inventory methods. So here you can see one company. This is Caterpillar. You know, they make heavy equipment. So Caterpillar reports inventory, they use FIFO, of $9.7 billion. And it tells you in its notes, because it has to tell you, that if they had used FIFO, this would be $12,298 million, $12,298 million, or $2,498 million greater. So the difference between LIFO and FIFO can accumulate over time, and it can become very significant. And so if you're looking at CAT's financial statements, because they're using LIFO, current assets have been underestimated by $2.5 billion. You're going to want to fix that. So the company, by choosing to use LIFO, the company is making a decision that it's going to report its balance sheet a little low, and it's going to kind of underestimate its assets by $2.5 billion. Now, what also tells you is that this company has recorded an additional $2.5 billion in cost of goods sold over time because it was using LIFO instead of FIFO. Remember, LIFO lowers your income. So over a long, long period of time, they've been using LIFO all along, and they've consistently reduced income because they were using LIFO. Now, LIFO doesn't reflect reality. FIFO does. Therefore, what we would be interested in doing is adjusting their income statement to see what would have happened if they had been using FIFO. By the way, so far, they've avoided paying $874 million in taxes, perfectly legally, by using LIFO. And therefore, they saved $874 million in cash paid for taxes by using LIFO. There's an interesting thing. LIFO catches up with you eventually, because what will happen is when you sell off your inventory and you sell the cheaper inventory, then you're going to have to pay higher taxes. But as you probably know, the new Tax Act, which was passed in December of last year, lowers the corporate tax rate. So if you've been using LIFO all along, and now you want to switch to FIFO, you're going to have to pay more taxes. But the tax rate has gone down so much that you will have saved and will never have to repay a huge amount of taxes by having used LIFO over this time period.